Could. I'm just, yes, sir.
My name's Roy Pantera. Would like to mention that I'm a former bank officer and board of directors member, now retired. On the date of last year's annual meeting, the market value of a share of First Chicago Common was around $31 per share. Today, the market value is about $23 per share. That $8 drop in market value between now and then represents a loss to all shareholders of some $538 million in market value. That's over $500 million. Why do I bring up the subject of market value? I bring it up because the market is the only true barometer of a company's financial condition. So what is the market saying? The market is saying that it cannot depend on consistent positive performance from FCC and continuously receives negative performance surprises. These surprises have almost consistently been centered in excessive loan losses. Just in the last 5 years alone, total loans charged off amounted to $2,876 million, $2,876 million, while total net income during that period was only $799 million. If the company would have had a more normal level of charge-off, income could have been almost tripled, and the stock market would have recognized this in higher stock value. Also, shareholders would have had more book value, and shareholders could have received more dividends. In 1990 alone, FCC charged off $874 million in bad loans, the highest amount in 5 years. In fact, total loan charge-off have consistently increased every year from $340 million in 1986 to the current $874 million in 1990. In 1990, FCC again surprised the market by announcing $515 million in loan loss provision for future expected loan losses. In the first quarter of 1990 alone, FCC shocked the market by announcing a provision of $100 million for expected loan losses centered in a loss to a single borrower, in a single region, in a single type of credit. FCC has continually assured shareholders that their credit risk management policies control concentrations of risk to any one borrower, to any one geographic region, or any one type of loan. FCC continues to experience loan losses from loans made outside the restrictions of what prudent loan policies should dictate. FCC's strategy of trying to be a super-regional bank and a global corporate bank has resulted in the company not achieving acceptable results at the combined bottom level. Notwithstanding almost consistent poor bottom line performance, FCC has rewarded management and employees with highly lucrative cash bonuses, stock incentive programs, and employee benefits. The determination of these rewards are not aligned with the combined bottom line to shareholders. In fact, the current proposal to provide 13 million shares in a pool for stock incentive awards is not tied to the bottom line performance of this company or the total return to shareholders. In fact, it may result in giving away at bargain prices in the future of 19% of the company's currently outstanding number of shares without any assurance of what total return shareholders will receive. It is the responsibility of the board of directors to assure consistent total returns to shareholders through the retention of capable management. In the face of this management's poor performance, their retention is tantamount to condoning such performances. I've outlined some problems. Now I'll quickly offer some solutions that shareholders view as necessary. One, the directors, as our elected representatives, must provide for management which produces consistent total returns for shareholders. Most of you outside directors are CEOs of major corporations, producing profitable returns to shareholders. I question which one of you would allow your corporation to be run like FCC and how long your shareholders would tolerate it. We suggest the board of directors employ outside management consultants led by a committee of the highest level of national financial leaders and academicians to determine the solutions to FCC's continuous operational difficulties. The responsibility for past and future management performance rests solely and squarely on the board of directors, and we shareholders intend to hold the directors financially responsible for continued losses of shareholder value. Two, directors must ensure that management structures loans on the fundamentals of lending, namely character, capacity, and collateral, then factor in economic conditions. Management continuously cites economic conditions as an excuse for excessive loan losses. The fact is, negative economic conditions will always exist, and management must factor potential negative conditions into their loan underwriting. Directors must insist that all bonuses of whatever type be tied to total shareholder returns. No one is opposed to incentive plans, stock options, cash awards, etc., but to be of value, they must include consistently increased total shareholder return. Directors should decide that FCC's future lies in being a good super-regional retail bank and not a combination of global and super-regional. Global banking was a drain on earnings last year, earning just 27% of the corporation's total earnings on 69% of the corporation's total assets, while the super-regional earned 73% of the corporation's earning on 31% of total assets. FCC's recent Chicagoland acquisitions places it in a prime competitive position to concentrate on this profitable retail banking segment of the financial services industry. Finally, the opportunities available for this corporation must be achieved without further loss of shareholder value. There are talented people available in the marketplace, as well as right here at First Chicago, who understand the meaning of performance and can take profitable advantage of the fantastic opportunities ahead for this corporation. Stockholders are sick and they're tired of poor performance. And to use a phrase, we're mad as hell and we're not going to take it anymore. We intend to hold directors responsible for the success or failure of this corporation. Thank you.
Maybe just a few comments. I didn't get the question, but I'll make a few comments. One is on the drop in the stock from 31 to 23, which is accurate. That did have a significant impact on the management, contrary to some of the things you said. One, there were no bonuses paid to senior management in 1990. And two, every stock incentive, every stock option awarded between 1983 and 1990 is underwater with the bank stock at 23. So the management understands how shareholder feels and are sympathetic to how shareholder feel. The consistency of earnings is an important observation. and our earnings have been inconsistent, as you've said. The principal source of the inconsistency is credit. We are not unique in that. Our business is credit. An important part of the business is credit. And we have to do a better job as we go ahead. So we don't take issue with the observation. I think we're passing through a tough storm, but we'll do well at the other end. Our directors have heard all your comments, and they will take them into consideration as they supervise the management of the business. As far as your last comment of no more loss of shareholder value, I'd like to do everything we can to do that, but we don't determine shareholder value. We determine the strategy of the place and how we execute, and I feel that our execution going forward will contribute to shareholder value. Dick, would you like to say anything?
Well, I think you've covered it pretty well. I was just going to point out that these numbers reflected a lot of research, I suppose, and they're probably accurate in the aggregate, but they've been presented in a vacuum without any basis of relating them to what has gone on in the industry. And I was also struck by the fact that we're using 5-year numbers in some cases, and I think we acquired your bank about 2 years ago, so 3 years of those numbers were apparent to the shareholders of the bank when we acquired the bank. So I think it was a little bit put out of perspective, but certainly the thrust is something that we worry about a lot, and I totally agree with the comments of Mr. Sullivan that we certainly share the pain, and we're going to do everything we possibly can to address the concerns of the shareholders.
Chairman?
Yep.
I would like to compliment the chairman in allowing Mr. Pantera a lengthy discussion on a sensitive subject. After all, what is the annual meeting of shareholders but to discuss the company's business? And I'd like to compliment you on allowing him to spend the time on this discussion.
Okay. Thank you.
I have a question also.
Sure.
That was a preamble. Of course, owning the shares for 14 years, I've insulated myself from market value. I have a question for Mr. Gilbert. Since Mr. Louis D. Gilbert of New York City submits shareholder proposals in many, many companies throughout the United States, a question he asks at all annual meetings of banks and insurance companies is how many times the trust department has voted for or against shareholder proposals. We gave the answer last year. If you don't have the answer at hand, you could put it in the post-meeting report. It'll be just as well.
No. Dick, do we have the answer at hand?
Yes, somewhere around 50 times we voted against management proposals last year. That is now a little more complicated because most of that is at American National, where they operate a lot of index funds, or an index fund. But I would say the trend is for us to be more discriminating and to vote against management proposals more frequently than we had in the past when we think that management proposals are really out of line. So about 50 times so far this year.
In the back.
My name is Mark Jacobs, and I'd like to ask you what your recommendation is going to be to the Board of Directors regarding the dividend. And in light of your comments about foreign loans and highly leveraged loans, what fall off in performance do you think will be necessary, assuming the dividend stays level now, for you to ask for a decrease, or think a decrease is warranted?
With respect to the dividend, we don't think it's appropriate to discuss in public what management will be recommending to the board, because we think it puts the board into a compromised position on dealing with the management. They ought to deal with the dividend as dividend, not just with a public pronouncement of the management. So we don't reveal that publicly. With respect to what could be circumstances that cause a dividend reduction, when we look at the dividend, we look at earnings, we look at capital, we look at conditions in financial markets as a whole. We look at the opinions of various stakeholders in the corporation. it's a broad-based consideration, and we really do it seriously every quarter. I don't want to speculate on what any of those conditions, if they change dramatically, could cause, but those are the major conditions we think about as we think about the dividend. I think there was, okay, go ahead, Ms. Glover.
Mr. Sullivan, my name is Al Glover, a shareholder of First Chicago Corporation and a 40-year employee who retired from the First National Bank of Chicago